Hello and welcome to our discussion on preparation of financial statements in the series of the preparation of financial statement in the lecture number 6. This is Professor Ramana, and to recap, we said that every business decision will involve financial items, and all these financial items will find place in the financial statements, balance sheet, income statement and cash flow statement. In today's session, we will try to understand the bad debts, and later on we get into the effect of the provision for doubtful debts on the financial statement. So bad debt is a loss due to the insolvency of the debtor. So debtors will reduce and the loss will be, or bad debt will be shown. Okay, bad debt will be shown in the income statement as a loss. Okay, that is the understanding expected effects on the financial statement. Now let us observe that with this example. As usual, we have a set of transactions, and here there is a bad debt of 200. We'll see how is the balance sheet, income statement, cash flow affected by that. Let us continue. As a capital is a source and capital is a receipt. Okay, capital is a receipt. So 1500. You purchase stock for cash. So stock purchase is a payment, 680, and is an acquisition of asset. So stock is 680. You sold 50% of the stock for 900. So the sales is equal to 900, but it is on credit. So there is a debtor. Debtor is 900. So debtor is 900. No cash flow because it is on credit. But whenever there is a sale, there has to be cost of goods sold, and the cost of goods sold is 50% of the stock that you purchase. So that is COGS, is an expense. And if the stock of goods sold will reduce the stock to that extent, so on the balance sheet the stock will go down. Expenses, so expenses for the period is 250, and you pay that expenses, so it's a cash outflow. So the entire expense is paid, so no outstanding liability for expenses. Now you see there's a bad debt of 200. So you're supposed to collect from the debtor 900, but 200 is becoming bad. So as we mentioned there in the PowerPoint, so bad debt is a loss. So 200 is a bad debt, is a loss, but is no cash inflow or cash outflow. But the debtors to the extent of 200 will reduce. So let us see this debtor. So debtor was 900 because of sales, no collection. The bad debt has happened, and bad debt is a loss due to the insolvency of the debtor. So debtors will come down to that extent. No other expense. So therefore let us find the profit for the period. So that is total expenses. Profit before tax is 900 minus 790. So PBT is 110, and the tax rate is given 30%. So therefore profit after tax is 77. Let us for the time being assume that the tax I'm paying, so there is a cash outflow. And this part, if no information is given, we assume that the firm retained the profit, so entire profit is retained in the business. Then let us find out the cash in hand for the firm. So cash receipts minus the cash payment. So cash in hand will be 1500 minus 963, and cash in hand is an asset. So cash in hand is an asset. Okay, so the balance sheet tallies. So the point that we wanted to mention here is a bad debt is a loss due to the insolvency of the debtor. Okay, that was the. So later on we'll see if this bad debt is not happening, but the firm is expecting that loss and therefore they want to create provision. But for the time being, we examine the effect of bad debt on the balance sheet. As we have mentioned here, bad debt will appear as an loss in the income statement. Debtors will reduce in the balance sheet. No effect on the cash flow for the bad debt. So bad reduces, debtor reduces. Okay, the debtor reduced and bad debt appears as a loss in the income statement. Thank you very much.